Right now, nearly half of the entire value of the S&P 500 is concentrated in a single sector. This hypergrowth in tech acts as a mask, obscuring the severe weakness developing in the broader underlying economy. Two macro markers show a crisis. Core inflation remains stuck around 3.4%, while the 10-year yield drifts toward 5%. Meanwhile, specific infrastructure stocks climbed 400% in a year, with implied volatility peaking at 95%. This creates a massive disconnect. Institutional money is aggressively bidding up tech assets and small caps, even as the broad economic data points toward a contraction. Investors now navigate two parallel markets on a violent, inevitable collision course. Because the U.S. economy is running nominally hot, the Federal Reserve has no immediate path toward rate cuts. The baseline market assumption of lower rates is effectively dead. The bond market is now dictating terms to equities. We're seeing short-term interest rates rise much faster than long-term rates. This dynamic, where yields rise across the board but the short end moves faster, is a bear flattener. It creates an immediate problem by drastically increasing the fiscal cost of servicing the U.S. national debt. Adding to this pressure is the rising threat of a supply shock. Geopolitical instability is tightening around global supply routes, particularly the shipping choke point at the Strait of Hormuz. A closure of that strait would drain global oil reserves to tank bottom within months. The resulting inflation spike would force the Fed to abandon all talk of cuts and move toward further rate hikes. These compounded risks ensure that high capital costs will persist, leaving traditional, broad market equities in a toxic and vulnerable position. Curious, yet despite these macro headwinds, the market is producing a strange anomaly. The Russell 2000 and select AI sectors are reaching all-time highs. Capital is rapidly shifting. Money is fleeing traditional software and SaaS companies to seek out the physical hardware required to run AI models. The most severe physical bottleneck in the entire chain is advanced AI silicon packaging. This is the complex process of stacking chips in 2.5D and 3D architectures to reduce energy consumption. EMCORE technology sits at the center of this. As a leader in outsourced assembly and testing, they provide the specific packaging services that giants like Taiwan Semi and NVIDIA cannot currently produce at scale. This physical necessity has caused EMCORE's valuation to explode. The stock has quadrupled, moving from under $25 to over $91 in just 12 months. But the options chain reveals a different story. Implied volatility on EMCORE has spiked to 95%. 95% volatility indicates the crowd has reached peak euphoria. Market makers are now pricing in a massive, violent price swing in the near future. While the AI infrastructure build-out is a real structural shift, the extreme euphoria surrounding these hardware bottlenecks is mathematically unsustainable over the short term. This setup, deteriorating macro conditions colliding with a localized tech frenzy, is a mirror of the 1998 market cycle. In 1998, the market suffered a violent mid-year crash that erased 20% of its gains before reversing into an explosive rally into the year's end. With current AI valuations at record levels, taking a simple long position right now carries significant risk. Institutional traders are instead structuring income trades. They're using the current high prices to harvest the expensive premiums built into the options market. For EMCORE, this setup is a skeeved short strangle. It creates a wide, flat profit zone independent of direction. Selling the 125 call and 70 put provides a massive safety berth, generating profit as the extreme 95% volatility deflates toward the center. To survive the collision between macro reality and the AI bubble, you have to look past the headlines. Ultimately, success in this market comes from trading the volatility itself.